Welcome back. Signs of strength in the banking sector once again this morning. Bank of America, the latest of the majors, reporting stronger than expected results on both revenue and earnings. Joining us right now is Mainstay Capital Management CEO and Chief Investment Strategist, David Kudla. David, good to see you. Thank you for joining us.
Thank you.
We had pretty good bank numbers last week, and we got more today on Bank of America. What's your takeaway on financials?
Well, we saw some strong earnings on Friday with the banks that reported Bank of America today. A lot of it is about trading, bond trading for Bank of America. Trading desk done well in the third quarter. But financials in general, we're looking for some good things to come from financials. We think that the Fed will raise rates in December. That will help their net interest margin. And for the big money center banks, that's important. Also the regional banks.
So getting back to that, the financials can be broken up into different sectors within it, right? So we like the exchanges, right? So we see they've got a great market share. They're growing. They're consolidating. It's doing really well. And the big money center banks have this financial regulation overhang coming down on them. Over 22,000 pages of regulation out of Dodd-Frank alone. So where else would you position? So would you more focus on the regional side like you had mentioned, or would you go to those big money center banks that have been coming out and doing well?
Great question. So we like financials across the board, and the big money center banks are going to do well. But we favor the regional banks, and specifically the smaller regional banks. No matter who we get for president here, we've got Trump has said he's going to reduce regulations, and Hillary Clinton has said she wants to reduce regulations on the small banks. So with that, we think the regional banks have an opportunity to perform, and especially when we get back to basic lending, we look at what's happened with Deutsche Bank, Wells Fargo. Big banks continue to have some reputational risk. The small banks are seen as the local hometown lenders, and we think they'll do better for a number of reasons. Yes.
That's great.
What about the broader markets? Where's the broader market going, you think?
Well, we're in an environment here where we've been able to grind higher, and we think we continue to do that. The concern is valuations are stretched. Certainly the market, by any measure, is fully valued, if not getting overvalued. Now, we know valuations are not enough to set the market back. There has to be that catalyst, and we've got a couple of things coming up here. We could have a geopolitical event, anything like that, to prompt it. And until then, though, we think that the recipe is in place for the market to just kind of grind higher.
What about a rate hike? Would that be a catalyst? Or is it because people are anticipating that so much?
Right. It's probably not the one rate hike in December alone. It may be more if rate hikes accelerate significantly. We've seen bonds and stocks move up together because of the Fed, and they could move down together. So our concern is either a policy misstep by the Fed, or
Janet Yellen doesn't appear to have a lead foot by any stretch of the imagination. Every time that she's even kind of nodded her head and hinted that there could be a rate hike, she gets, well, frightened, frankly.
Yeah, they seem to be willing to err on the side of letting the economy overheat, if anything, letting lower rates run for longer.
We've had 88 months of expansion, and it seems to me, well, what's the likelihood of having a recession in the next president's first term, in the next 4 years?
Very likely.
Very likely.
I think very likely only because of where we are in the economic expansion. By the time we get to the end of that term, if we're still in an economic expansion, it'll be the longest in history. And we are operating dangerously close to recessionary levels now. GDP over the last few quarters has only grown at about 1%. We've seen job growth slowing. Wage growth is still anemic. So, there are some concerns there. I don't see it on the horizon as imminent, but if we look over 4 years and where we are in the economic cycle, it's quite likely based on historical precedents.
Is there anything you could point to that would break us out of that? I mean, we talk all the time about tax reform, about the rollback of regs. What would it be that actually triggers some economic activity and unleashes business?
Well, I think it's, when we look at this economic expansion, we've been growing very slow. So we talk about lower rates for longer when we're talking about the Fed and interest rates. Another thing we talk about is slower growth for longer. We're just growing so slow that in itself could expand this economic cycle further. But we've never reached escape velocity for this economy. We've never seen those repeated 4% and 5% GDP quarters. So I think we're going to keep looking at these fits and starts, and there's that risk that'll be there and probably increasing.
But that's why I think tax reform is so important, because I feel like there is a potential to get business unleashed.
Yeah, the only way to do it is through fiscal policy. We've seen the efficacy of monetary policy has hit its wall. We've thrown an unprecedented amount of monetary policy at the markets through bond buying programs. The Fed's balance sheet is still at $4 trillion. Not much more you can squeeze out of that lemon. There's nothing you can do. The Fed governors are saying it themselves. That's why they're going to raise rates in December, because they're saying we've done enough. The economy's where it's at right now, and if they don't do it, that's going to scare the market, and it could go down if they don't raise rates.
And when you look around the world, you look at the ECB at the last meeting. What did Mario Draghi do? He said, I'm done for now.
Right.
He said the countries with fiscal space, Germany, need to do something on the fiscal side. In Japan, they're trying to find their way, right? And really, that's what we need everywhere.
Right.
We need a shift in policy from monetary to fiscal, and that could be the catalyst.
And that's what I'm talking about, tax reform and a rollback.
Conflicting notions. I mean, if we were to dip into a recession, how does the Fed respond?
They can't stop. They can't raise interest rates in the face of recession.
They will cut rates. They will buy more bonds. That's exactly what they will do, because the government won't really do anything until the government does a fiscal policy. They will do that.
And we'll just wait for tax reform.
Yeah.
David, good to see you. Thank you so much, David Kudla there.